Welcome to Info Sounds by InfoDrip, your go-to source for insightful discussions and explorations. Each week, we break down complex ideas into clear, engaging conversations designed to inform and inspire.
Welcome back to the Deep Dive. Today we're tackling money market funds, specifically in Kenya.
They're kind of like savings accounts, but with a bit more oomph.
Move, meaning?
Instead of your money just sitting in the bank, it gets pooled with other investors.
Okay, interesting.
And then that pool is invested usually in low-risk things like Treasury bills, aiming for a slightly better return than a standard savings account.
Got it. So a bit more action, a bit more potential, but still relatively safe.
You got it. And there's typically the benefit of professional management, too.
Makes sense. You don't have
Yeah.
to be a stock market whiz to potentially benefit.
Well,
Well, lucky for us, we've got this in-depth report here evaluating money market funds in Kenya, put together by the folks at InfoDrip Limited.
oh, that's a good one, yeah. Gives a really solid overview of how these things work in the Kenyan context.
Perfect. That's what we like to hear. So if you're ready, let's dive right in. What's the big picture here? Why are money market funds, or MMFs, as I guess we'll be calling them,
Right.
why are they gaining traction in Kenya?
Well, Kenya's financial market has been growing and diversifying quite a bit, right?
It has, yeah.
So for investors, MMFs are becoming a bigger piece of the puzzle.
And they're regulated, right?
Absolutely, yeah. The Capital Markets Authority, the CMA, is the body that oversees all this.
Okay, good to know. Adds a layer of security there. So we've got this growth, we've got the regulation. What's the draw for the everyday Kenyan investor?
Well, as we said, there's the potential for higher returns compared to just stashing cash in a regular savings account.
Makes sense.
Plus, it's generally pretty easy to access your money when you need it. That liquidity is important.
True. And of course, you've got experts handling things, making those investment decisions.
Right. And another big one is diversification.
Meaning?
Well, these MMFs pool money from a bunch of different investors, right?
Yeah.
So they can invest in a wider range of stuff than any one person could on their own. Spreads the risk around a bit.
Okay, so that's appealing. All right, so let's get down to brass tacks here. How do these MMFs actually make money? Not just for the investors, but for the funds themselves.
Primarily through interest.
Interest, okay.
Remember those short-term debt instruments we mentioned?
I do, yeah.
Those instruments pay interest, which is also known as a yield. That's where the primary income comes from.
Got it. So it's about those yields, making them work.
Exactly.
Now, I'm guessing it's not just a case of set it and forget it. There's active management going on, right?
Oh, absolutely. Lots of moving parts. Think about it. Those instruments mature pretty quickly.
They do, yeah. That's the whole short-term aspect.
So as those instruments mature, the fund managers have to reinvest that money, keep things rolling. It's a constant cycle.
Constantly putting that money back to work. I like it.
And then there's this thing called the yield curve.
Yield curve. Okay, I'm intrigued.
It basically shows the relationship between interest rates and the amount of time an investment is held for.
So if I'm understanding right, a steeper curve means you get a higher interest rate if you're willing to lock your money in for longer.
Exactly. And good MMF managers can use this curve to their advantage. How? Well, they might choose to invest in a mix of instruments, some that mature quickly, some that take a bit longer. That way, they can potentially capitalize on changes in interest rates, whichever way those rates go.
So they're not just riding the wave, they're actively surfing it.
Exactly. It's dynamic, strategic.
Now, I'm sure there are fees involved, right? Like with any financial product.
Oh, of course. Management fees, administrative costs, those sorts of things.
And those fees cut into the investor's returns, obviously.
Right, which is why it's important for these MMFs to keep their expenses as low as possible. The less they spend, the more the investors potentially earn.
Makes perfect sense. So far, this all sounds pretty positive. But no investment is without risk, right?
That's very true. Even with MMFs, which are generally considered fairly low risk, there are some potential downsides to be aware of.
Let's talk about those. What are the potential pitfalls here?
Well, first off, there's the ever-present threat of inflation.
Right. Even if you're earning a decent return, if the cost of goods and services is rising faster.
Exactly. Your money might be growing, but its purchasing power could be shrinking.
Not ideal. What else?
Then there's credit risk. It's rare, but it's possible that an issuer of one of those debt instruments, even a seemingly solid one, could default.
Meaning they wouldn't be able to repay the borrowed money.
Right. And if that happens, the MMF, and by extension the investors, could lose money.
So even with these low-risk investments, there's no such thing as zero risk.
Exactly. And then there's interest rate risk.
Which is?
Well, if interest rates go up, the value of those existing investments within the MMF can actually go down.
That seems counterintuitive.
It can be a bit tricky, yeah. But it's something to keep in mind.
So your investment could take a bit of a hit, at least on paper, even if you haven't technically lost any money.
Right. It's all about understanding how those interest rates move and what impact they can have.
Okay, so we've got inflation risk, credit risk, interest rate risk. Anything else?
There's also something called liquidity risk.
Liquidity risk, meaning?
Well, usually MMFs are very liquid, right? You can access your money fairly easily.
Yeah.
But in extreme situations, during a major financial crisis, for example,
Yeah.
it could become difficult to get your hands on your money quickly.
Okay, that makes sense. It's like a run on the bank kind of scenario, I suppose.
Kind of, yeah. It highlights the importance of choosing a well-managed, stable fund.
Absolutely.
Right, a really solid fund that's going to weather those storms. And it's important to remember, MMFs are not about getting rich quickly.
They're not about chasing those huge gains.
Exactly. They're more about stability, slow and steady growth, a bit more return than your basic savings account.
Got it. So don't expect to retire early on MMFs alone.
Probably not. You're trading that high growth potential for lower risk. And another key difference from a typical savings account is that, here in Kenya at least, MMFs are not covered by that government-backed insurance.
Ah, right. So with a bank account, if the bank goes belly up,
You're usually protected up to a certain amount.
yeah.
With MMFs, that protection isn't there if the fund itself runs into trouble.
There's no guarantee you'll get all your money back.
Exactly. Important to be aware of that.
It is. And of course, there's always the matter of fees.
Always. Those fees can really eat into your returns over time.
They can, yeah. Which is why I'm glad we have this info drip report. They've actually broken down the fee structures of some of the biggest MMF providers here in Kenya.
It's a handy comparison for sure.
It is. So should we take a look at some of these providers?
Let's do it.
Okay, first up, we've got CIC Money Market Fund, managed by CIC Asset Management. From what I'm seeing here, they seem to be pretty focused on delivering competitive returns while also keeping a close eye on risk.
Yeah, they've got a good reputation for consistency, and their fees are pretty reasonable. Plus, their management team has a lot of experience, a solid track record.
Sounds promising, but I'm sure there are things to watch out for, right? No investment is perfect.
Of course. Like all MMFs, they're still exposed to those inherent risks we talked about earlier. Inflation eating away at returns, interest rates potentially fluctuating, and so on.
Right, those risks are always lurking. Okay, what about Britam Money Market Fund? That's managed by Britam Asset Managers. What are they known for?
Well, they're big on technology. They've got great online platforms, really user-friendly, makes it easy to track your investments, manage your money.
Convenient.
Very. And they tend to offer pretty attractive yields, too.
So convenience and potentially higher returns? Sounds appealing. But I'm guessing there's a flip side.
There always is. Their fees can be a bit on the higher side compared to some of the other MMFs, and their returns can be a bit more volatile, meaning they might fluctuate a bit more.
So, a bit more of a roller coaster ride. Okay, on to the next one. NCBA Money Market Fund, managed by NCBA Investment Bank. What's their story?
They're really focused on providing a safe and straightforward investment. They stick to those top quality instruments, have a good history of performance, and keep their fees competitive.
And NCBA itself is a pretty well-established institution in Kenya, right?
Oh, yeah. Very reputable.
So that adds a layer of trust, I suppose.
It does. However, it's worth noting that if there's a major market shock, some extreme event, they could face some liquidity challenges.
Meaning it might be harder to access your money quickly in those worst-case scenarios.
Exactly.
All right, good to know. What about Sanlam Money Market Fund, managed by Sanlam Investments? What sets them apart?
Sanlam is really big on diversification, spreading those investments around. And they're known for being very transparent with their investors. Lots of communication, detailed reports, that sort of thing.
I like that. Keeping people in the loop.
Right. Transparency builds trust.
It does. What are the downsides, though?
Well, as with most MMFs, their returns can be affected by changes in interest rates and overall market conditions, things that are outside their control.
Right, so those external factors always play a role.
They do.
Okay, let's wrap up our tour of these providers with ICEA Lion Money Market Fund, managed by ICEA Lion Asset Management. What's their deal?
They're known for consistently delivering competitive returns while also keeping fees low. Their management team is experienced and has a good, stable track record.
Sounds solid,
Right.
but I'm sure there are trade-offs. There always are.
Well, one thing to be aware of is that their returns might lag a bit if interest rates are really low.
Ah, so they might prioritize stability over chasing those higher returns in a really hot market.
Exactly. It's always a balancing act.
It is. Okay, so we've looked at 5 different MMF providers here in Kenya,
Right.
but obviously this is just a snapshot.
Right. There are others out there, and it's important to do your homework before making any decisions.
Yeah, absolutely. Don't just jump in because a name sounds familiar.
Right. Look at their performance history, those fees, the management team's experience, how much risk they're taking on, all of that.
And how all of that lines up with your own risk tolerance,
Yeah.
right? How much risk are you comfortable with?
Exactly. It's a personal decision.
Now, let's zoom out a bit here.
Yeah.
Kenya, like a lot of developing economies, faces various political and economic uncertainties.
Right. Those uncertainties are always part of the equation.
How do those uncertainties, those potential risks, how do they affect the MMF landscape specifically?
Well, think about it this way. Political instability creates uncertainty, right?
Makes sense.
And uncertainty can make investors nervous.
So they might pull their money out of the country, seeking safer havens elsewhere.
Exactly. It's called capital flight.
And if that happens, if there's a big outflow of capital, that weakens the Kenyan shilling, right?
Right. It can lead to currency depreciation.
So your investment, even if it's doing well in terms of Kenyan shillings, could be losing value because the shilling itself is weakening.
Exactly. It's a double whammy.
Not fun. And then there's the issue of economic instability, separate from the political stuff.
Right. Things like high inflation, which we've talked about already,
Yeah.
rising interest rates, a general slowdown in economic growth.
Yeah.
All of that can have an impact.
Right, because those factors can affect the yields on those debt instruments that the MMFs are investing in.
Exactly. If the economy is struggling, those yields might go down, which means lower returns for investors.
Okay, so it's all connected. The political stuff, the economic stuff, it all feeds into the MMF market.
It does. It's all part of the bigger picture. And it's
So how likely they are to default on their debts?
exactly. A higher credit rating generally means a lower risk of default.
Okay, so that's something to look for. What else?
You can also look at their capital adequacy ratio,
Which tells us,
how much capital they have as a buffer against potential losses.
so the higher that ratio, the better equipped they are to handle tough times.
Right. They've got more cushion. What else? Ah, their history of profitability.
Have they been consistently making money?
Right. And are those profits sustainable? Also, look at the quality of their assets. Do they have a lot of bad loans on their books?
Okay, so it's like checking their financial health, making sure they're in good shape.
Exactly. And then there's corporate governance.
Something about.
How well they're run, basically. Do they have a strong board of directors, independent auditors? Are they committed to ethical business practices?
So it's about trust, transparency, accountability, all of that.
Exactly. You want to feel confident that the people managing your money are doing things the right way.
Absolutely. Okay, so we've talked a lot about the numbers, returns, fees, ratios, all of that. But investing is also about emotions, isn't it?
It is, yeah. Psychology plays a big role.
So how do those softer factors, those less tangible things like trust and reputation, how do they fit into the picture?
Well, choosing an institution you feel good about, one that aligns with your values, one that you trust,
Yeah.
that can make the whole investing experience a lot less stressful.
Makes sense. But how do we assess those things? There's no trustworthiness rating agency, right?
Not exactly, but talk to other investors, get their feedback, see what their experiences have been.
Word of mouth.
Right. And check online reviews, see what kind of reputation they have out there.
And of course, trust your gut.
Always trust your gut. If something feels off, it probably is. Don't ignore those red flags.
Great advice. Now, before we move on, I want to touch on something that's really crucial for making smart financial decisions. Financial literacy.
Oh, that's foundational. Absolutely.
It is. And
Yeah.
it's something that everyone needs, regardless of how much money they have or what their financial goals are.
Right. It's about empowering yourself to understand and manage your money effectively.
So what are some key aspects of financial literacy that we should be focusing on, especially when it comes to things like MMFs?
We'll start with the basics of personal finance. Budgeting, saving, managing debt responsibly, those are the building blocks.
Yeah, get those foundations in place.
Then, understanding different types of investment products, stocks, bonds, mutual funds, MMFs, how they work, what the risks are, all of that.
in that whole concept of risk and return.
Right. Higher potential return usually comes with higher risk. There's no magic bullet.
No free lunch.
Exactly. And always be aware of those fees and expenses that come with different investment products. They can really chip away at your returns if you're not careful.
They can, for sure. Okay, so we get it. Financial literacy is important. But where do people go to actually learn this stuff? It can seem intimidating.
There are tons of resources out there, websites, books, articles, even online courses that break down these concepts in a really accessible way.
And a lot of financial institutions offer educational resources too?
They do, workshops, seminars, that sort of thing. And don't hesitate to reach out to a financial advisor. They can answer your questions and give you personalized guidance.
That's a great point. Sometimes having a real person to talk to makes all the difference.
It does. Okay, so we've talked about financial literacy. Now, let's circle back to diversification, which we touched on earlier.
Right, that whole don't put all your eggs in one basket idea.
Exactly. But why is diversification so important? Well, the main reason is risk reduction.
Okay, explain that.
If you're invested in a bunch of different things and one of those investments takes a hit,
Yeah.
the others can help cushion the blow.
So your overall portfolio isn't as affected.
Right. It's about spreading that risk around. And diversification can also potentially boost your returns over time.
Really? I thought spreading things out would actually dilute the potential gains.
Not necessarily. Different asset classes tend to perform differently depending on what's happening in the market. Stocks might be doing great while bonds are flat, or vice versa.
Okay, I see. So by having a mix, you're increasing the odds that at least some of your investments are doing well at any given time.
Exactly. It smooths out the ride, potentially leading to higher overall returns in the long run.
So diversification is good.
Yeah.
Got it. But how do we actually go about building a diversified portfolio? Where do we start?
One common approach is to allocate your investments across different asset classes: stocks, bonds, real estate, even commodities. Don't put all your money into just one of those buckets.
Okay, spread it around.
Right. And then within each asset class, you can diversify even further. So instead of putting all your money into a single company's stock,
Yeah.
you could invest in a mutual fund that holds stocks in a bunch of different companies.
Right, spread it around even more.
Exactly. And don't forget about geographic diversification.
Yeah, I know.
Investing in different countries or regions. That way, if one part of the world is having a tough time, your whole portfolio isn't necessarily dragged down.
Makes sense. So it's about spreading your investments across different types of assets, different companies, even different parts of the world. But how do we know what the right mix is for us?
That's where things get a bit more personal. It depends on your risk tolerance, how long you plan to invest, what your financial goals are.
So a younger person who's saving for retirement decades from now might have a very different mix than someone who's nearing retirement.
Exactly. And your financial goals matter too. Saving for a down payment on a house is different from saving for your child's education, right?
Right. Different timelines, different levels of risk you might be willing to take on.
Exactly. That's where having a financial advisor can be really helpful. They can help you figure out your risk tolerance, understand your goals, and create a portfolio that's right for you.
Okay, so diversification is about managing risk and maximizing returns, but it's also about finding the right balance for your specific situation.
Right. It's not one size fits all.
Now, I want to touch on a topic that's gaining a lot of traction these days: sustainable investing.
Ah, yes. It's becoming increasingly popular.
It is. So what is it exactly?
It's basically about investing in a way that aligns with your values. Putting your money into companies and projects that are environmentally responsible, socially conscious, things like that.
So making money while also doing good in the world.
Exactly. It's about having a positive impact.
I like it. And how do people actually go about doing this, incorporating sustainability into their portfolios?
There are a few approaches. One is investing in companies that are considered leaders in environmental, social, and governance practices.
So companies that are actually walking the walk when it comes to sustainability.
Right. And there are mutual funds and ETFs that specifically focus on this type of investing, making it easier to get involved.
Okay, so you don't have to be a Wall Street expert to do this.
Not at all. Another approach is active engagement. Actually talking to the companies you're invested in, encouraging them to adopt more sustainable practices.
Interesting. So using your voice as an investor to try to influence things.
Exactly. And some investors choose to divest from certain companies or industries that they see as harmful.
So pulling your money out of those companies entirely, making a statement with your investment choices.
Right. It's about aligning your money with your values.
But how do we know if these so-called sustainable investments are actually making a difference?
That's a great question. It's crucial to do your research. There are organizations that track and rate companies on their sustainability efforts.
Okay, so some independent verification is important.
It is. Don't just take a company's word for it. Look into what they're actually doing.
Good advice. Now let's talk about something that I think can be a real challenge for a lot of investors, especially in a fast-paced world. Patience and discipline.
Ah, yes. Those are essential virtues for any investor.
They are. But it's so easy to get caught up in that get-rich-quick mentality.
It is. But the truth is, investing is a marathon, not a sprint. It's about slow and steady growth over time.
And that takes patience.
It does. The market will go up, it will go down, that's inevitable. But you have to ride out those fluctuations, not panic and sell everything when things get a bit bumpy.
Easier said than done.
Right. It can be, yeah. But that's where discipline comes in. It's about sticking to your investment plan, even when it's tempting to deviate.
So if you've decided to allocate a certain percentage of your portfolio to stocks, a certain percentage to bonds, whatever it might be,
Yeah.
you stick with that plan, even if the market takes a dip.
Yeah.
Even if your friends are bragging about their hot stock picks.
Exactly. Don't let emotions drive your decisions.
Solid advice. Okay, but how do we cultivate those qualities, patience and discipline?
Well, one way is to stay focused on your long-term goals. Remind yourself why you're investing in the first place. Is it for retirement, your children's education, whatever it might be?
Having that bigger picture in mind can help.
It can. And automate your investments if possible. Set up regular contributions to a retirement account, a mutual fund, whatever it is.
So you're putting money away consistently without even having to think about it.
Exactly. It takes the emotion out of it. And remember, this is a long game. Don't get discouraged if you don't see huge returns right away.
It's about consistency, about staying the course.
Right. Now, another important aspect of successful investing is staying informed and being adaptable.
Because the world is constantly changing.
It is. What worked last year might not work this year, so you have to stay on top of things.
So what should we be keeping our eyes on? What are the key things to watch?
Well, the overall economic environment is a big one.
Right, things like economic growth, inflation, interest rates.
Exactly. Those factors can have a huge impact on different asset classes. Also, geopolitical events.
Yeah.
Wars, elections, natural disasters.
Yeah. Those can really shake things up.
They can. And don't forget about industry trends. New technologies, changing regulations, shifts in consumer behavior. Those sorts of things can create opportunities or risks for investors.
So it's about paying attention to the big picture, the global trends, but also what's happening in specific industries.
Exactly. It's about connecting the dots.
But where do we go to get all this information?
There are tons of resources out there, financial news websites, blogs, podcasts, magazines, journals.
And of course, there's always your financial advisor.
Right. They're tuned into all of this stuff and can provide tailored advice.
Okay, so we're staying informed, we're paying attention to the world around us. Now, how do we actually adapt our investment strategy based on all this information?
Well, the first step is to think about how those developments could potentially affect your portfolio. If interest rates are rising, maybe you shift a bit more towards bonds. If a certain industry is booming, maybe you increase your exposure there.
So it's about being proactive, making adjustments as needed.
Exactly. You're not just passively riding the wave, you're actively steering. And of course, if you're ever unsure about what to do, don't hesitate to reach out to that financial advisor.
They're there to guide you.
They can help you make sense of it all. Create a plan that really works for you.
Right, because it's not one size fits all.
Exactly.
Okay, we've covered a lot of ground here. MMFs, the Kenyan market, risk, diversification.
A bit of everything.
We have. But before we wrap up, I want to circle back to something you touched on earlier, the whole idea of setting realistic expectations.
Oh, that's so important. It's easy to get carried away.
It is. Especially these days, you see all these stories about people getting rich quickly. It's tempting to think, hey, maybe I can do that too.
Right, but the reality of investing is usually a lot different. It's more about patience, about slow and steady growth over the long haul.
Not about hitting the jackpot overnight.
Exactly. And that means understanding that there will be ups and downs along the way.
The market doesn't just go straight up.
It doesn't. There will be dips. There might even be periods where you see some losses. It's normal.
So you've got to be prepared for that.
It'll-
Freak out when it happens.
Exactly. It's part of the process. And a big part of being prepared is understanding your own risk tolerance. How much risk are you truly comfortable with? Because there's a trade-off, right?
Right. Higher potential returns often come with higher risk.
So if you're someone who stresses out over every little market fluctuation, maybe you stick with those more conservative investments.
Find that balance.
Exactly. Find what lets you sleep at night. And be realistic about the returns you can expect. Don't fall for those promises of guaranteed high returns, especially if they're also claiming low risk. It just doesn't work that way.
So how do we set those realistic expectations?
Well, looking at historical returns can be helpful. It gives you a general idea of what different asset classes have delivered over time. But remember, past performance doesn't guarantee future results. It's just a guide.
Right, things change.
They do. And the current economic climate matters too. What are interest rates doing? Is the economy growing or slowing down? All of that factors in.
So you have to stay informed and adjust your expectations as things evolve.
Exactly. Now, you mentioned seeking professional advice earlier.
I did. It's something I always stress. Having a good financial advisor can be a game changer.
It can be, for sure. They can help you with all of this stuff we've been talking about. Creating a plan, setting expectations, managing risk, navigating the market.
Right, they're like your guide.
Exactly. But finding the right advisor, that's important too.
So what should we look for?
Well, first and foremost, qualifications and experience. Are they certified? Do they have a proven track record? You want someone who knows what they're doing.
Makes sense. It's your money, after all.
Exactly. And just as important, you need to trust this person. You'll be sharing a lot of personal financial information, so you have to feel comfortable with them.
Like any relationship, it's about trust and communication.
Exactly. And finally, make sure their fees are reasonable and transparent. You don't want any nasty surprises down the road.
No hidden costs. Okay, so we've found our financial guru. What happens next?
Well, they'll start by getting to know you, your financial situation, your goals, your risk tolerance, all of that. It's a very personalized process.
They're building a picture of you, your financial life.
Right. And then they'll create a plan, a roadmap, so to speak, for how to achieve your financial goals.
I like that analogy, a roadmap.
And that plan should be reviewed and adjusted regularly because life changes, your circumstances change, the market changes. It's not a static thing.
So it's an ongoing relationship.
It is. They're your partner on this journey. Okay, so as we wrap up our deep dive into money market funds in Kenya, what are the key takeaways here?
All right, let's recap. MMFs can be a good option for Kenyan investors who want a relatively safe and liquid way to potentially earn a bit more than they would with a basic savings account.
Right. But it's important to remember that there are risks, even with these low-risk investments.
Inflation, interest rate fluctuations, that lack of government-backed insurance.
Right. Those are all things to consider.
And when you're evaluating specific MMFs, remember to look at their historical performance, their fees, the management team, how much risk they're taking on.
And how all of that aligns with your own risk tolerance.
Exactly. It's about finding the right fit for you. And we also talked about the bigger picture, how things like political and economic instability can impact the market.
Right. It's all connected.
And of course, we can't forget those detours we took into the world of financial literacy, diversification, sustainable investing.
Right. Those are all important pieces of the puzzle.
They are. So as we wrap up, what's your final thought for our listeners?
Do your research. Don't just jump in blindly. Learn about different MMFs, compare them, maybe even talk to a financial advisor. The more informed you are, the better decisions you'll make.
Excellent advice. Knowledge is power.
All right, that's it for our deep dive into Kenyan money market funds. Thanks for joining us.
Happy investing.